there is a massive bubble that has formed in the AI market. Estimates are that tech giants in the US have invested approximately $560 billion in AI over the past 2 years. Those same companies have only brought in approximately $35 billion in AI-related revenue in that same period of time. In a report released in September, Bain & Company estimated that by 2030, the cost of just the computing power needed to meet the projected AI demand will reach about $2 trillion, while revenues are expected to only hit $200 billion by that same time. Obviously, this is unsustainable long term, but investment companies have been doing this for years. Just like the dot-com bubble in the late 90s, the AI bubble will pop. Companies will stop wildly investing in bigger and more expensive AIs. But what does this mean for AI? At what point does the music stop? And when it does, who is left without a seat? That's what we're going to discuss in this video. Now, if you don't know me, my name is Tim Corey, and I've been a software developer for over 25 years, and I've been a Microsoft MVP for the past 9 years. I spend my days researching software development, talking to those building the applications we use, and then teaching others how to navigate a successful career as a software developer. Well, I offer over 800 free training videos here on YouTube, including 9 full free courses. Take advantage of those. But I also offer paid training at IamTimCorey.com. Recently, I released a course titled Navigating AI, where I explain what AI actually is, how to see past the hype, how to avoid being replaceable while also utilizing AI to further empower your career. AI is here to stay. Knowing how to work with it is important, but we also have to have a good perspective on what to avoid and know where it is going. So let's talk about that. Now, everything I'm going to cover today is backed by tons of research and real-world information. I'll be linking a lot of resources in the description, as well as showing the links on the screen when appropriate, so you can read the articles for yourself and get more of an in-depth look at what I'm talking about, as well as get more context around these various things. But here's the bottom line. The AI bubble is going to burst. It may be a loud pop, it may be a small deflation, but either way, it's going to burst. And that will have far-reaching consequences to the industry. But that does not mean that AI will go away. Just remember, we had the dot-com bubble burst in the early 2000s, and we still have a whole bunch of dot-com companies. So just because a bubble burst doesn't mean that things go away. It just means that things will change. So let's talk about the outline of what we're going to cover, and we'll start getting into some hands-on illustrations of what's going on. So first we're going to cover, what's a bubble? And then we'll get into what happened with the dot-com bubble in the late 90s, and then jump into the signs of the current AI bubble. Number 4, we'll talk about what probably happens after the bubble breaks. Number 5, we'll cover what that means for developers. And finally, we'll talk about how to avoid being in the broken parts of that bubble. We want to avoid getting run over by this huge bubble. So let's jump in and talk about what is a bubble. So to do that, we're going to do some illustrations here. So here I have an illustration of a fictional food cart industry, right? So the food truck industry, the total market is $100,000 a year, meaning the people who buy from food trucks are going to spend $100,000 total. And in this illustration, we have 20 different food trucks that are competing in this market. That's kind of what we're doing. We're building up. AI companies, you probably noticed there's a lot of them out there. There's not just 1 or 2. So this is what we're talking about. We're having lots of companies competing for trying to make AI work. Well, in this case, it's trying to make food trucks work. So let's pretend that because of the inflated prices, you have to pay $100,000 to buy a food truck. And you decide, I'm going to buy this food truck. Well, you spend $100,000 and you're going to earn about $5,000 worth of profit per year. We're going to call it profit. So that profit is going to go towards your loan. Well, That's 20 years to pay back with 0% interest. We don't have 0% interest. So you got to think through, we're talking 25, 30, 35, 40 years before you get your money back on that food truck, which is just not sustainable, right? But everybody's doing this. So this is what's called a bubble, where you are speculating that because of the buzz of your food truck, you're going to bring in more money. And some of that is just saying, hey, I want to get a bit more of this $100,000 pot. But what really is going to happen is you're going to play a game of chicken. Who has the most money to burn? Because at some point, because all your competitors, let's just say they all did the exact same thing. They all spent $100,000 and are making about $5,000 a year in profit. Well, at some point, this food truck and this food truck are going to start running out of money. And maybe they get to a point where they're like, hey, I just need to get out of this. I can't keep losing money. I need to have some type of return on investment before the bank just takes it all. And maybe you say, you know what, I will buy your food truck for $20,000. And I'll buy your food truck for $15,000. So now what you have is you have 3 food trucks, but your total investment, instead of being $100,000, now it's $135,000, right? So you've invested even more money and you're starting to buy things up because they start to become cheap. And your income right now is still only $15,000. Now it's better than $5,000, and you're going to make back, this food truck after 3 years plus interest, and this one after 4 years plus interest, but that's still kind of long. But here's what you're really looking for. You're looking for these food trucks to go, you know what, we can't afford to be in this market, and they go bankrupt and they just go away. And then, this section down here, they're like, we can't afford it either, and we're going to go bankrupt, or we're going to have the bank seize our food trucks. And what you have left is just a couple of food trucks left. Well, now, instead of making $5,000 per year for each of your food trucks, you're dividing the pot of $100,000, same amount of money. But now, if everything is equal, you're making $75,000 instead of $15,000. Well, now you can pay those loans back in 2 years, right? You've outlasted the market. And what happens is you're also now a market leader. You have 3 to 4 food trucks. If you start saying, hey, you know what, we're going to raise prices a little bit, we can get a little bit more money out of the same pot. And maybe you kind of push that market to be more sustainable for you, where you're not making just $75,000, maybe you're making $110,000, $120,000. And now all of a sudden you're boosting the market. This is what a market bubble is, where companies are going to lose money, lots of money. And they're going to kind of hold on to see if we can get the best product or the one that lasts the longest even, and try and gobble up those other businesses that fail, until what you have is you come out the other side of a bubble burst, where you no longer have 20 food trucks, you now have 4 in the market, but you own the majority, you're the market leader, and all of a sudden now you have the market kind of on lockdown, you are the leader. So this happened with the dot-com bubble. So let's talk briefly about that. The dot-com bubble happened in the late 90s and early 2000s. And let me show you when it burst. Okay. This is the NASDAQ, which is like tech stocks mainly. And this is from January 1st of 2000 through the December 31st of 2002. And notice that up here, we're in the 5,000 point range for the NASDAQ Composite Index. And then we start dropping off. And in fact, in one day, we went down to 3,300. Kind of came back up for a little bit. But by the end of 2002, we were down to about 1,300 points. That's about an 80% drop in market value. So that was a big deal. When that bubble burst, and it didn't burst as in pop one day, everything's gone. Now there was some significant droppage right here, that, it was a big deal. But overall, it took about 2 years where companies kept failing and running out of money and getting acquired. And around that time, there's about $5 to $7 trillion in value. Now, it's not real money, but it's value. What a company is expected to be worth, about $5 to $7 trillion was lost in this period of time. Now, how does that impact people? Well, about 60% of the dot-com companies that were, built up over the late 90s and early 2000, about 60% of them shut down, just gone. Others were acquired and other things, but about 60% just went away. And because of that, about 200,000 people were laid off. That's a lot. And funding went from $105 billion in venture funding down to about $20 billion by the time we get down at the end of 2002. So, but that looks horrible. But what came out of that? Well, Google, which was established in 1998. We know where Google is today, right? eBay was established in 1985. We know where eBay is. And Amazon, established in 1994, they're now the market leaders. They're now owning a large portion of their niche. If you want to shop online, where's the first place you typically think? Amazon. When you're talking about, I've got an online shopping problem, what are you normally thinking about? Amazon boxes showing up at your door every day, right? Until AI came out, where was the place you went to look for something on the internet? You went to Google. In fact, we use the word Google as a verb. I'm going to Google that, because Google became synonymous with looking things up. If you wanted to go to an online, to sell your things online, you wanted to do an auction type thing, where do you go? You go to eBay. You don't go to the dozens of other competitors for online sales and auction houses. eBay became the market leader for online auctions. So yes, there was a massive crash through here. There was a massive reduction in market value. The bubble burst and it caused a major issue. However, out of it came some market leaders. And that's going back to our food truck analogy here. This is what we're looking at, is who's going to come out of the bubble crash as the market leader. And that's why so many companies are investing so much money. You look at OpenAI, they're working really hard to be the market leader because they want to come out the other side of the crash or the pop, where is a full crash or just a deflation. Either way, they want to come out the other side being the market leader. When you think AI, you think OpenAI. When you think AI, you think ChatGPT or, all their other pieces to that. So that's what they're looking to do. Now, let's talk about the signs of a bubble bursting, because there are signs to look for. And I think that I've pulled out a number of articles and kind of pointed to some various things. So I have these linked down below, but there's also the link below each screenshot. I want to make sure I give attribution. This is not just me saying these things. These are from a number of different sources, from a number of different people, from a number of different researchers. So this one, the numbers just don't make sense. The AI build-out requires companies to collectively fund a new Apollo program, not every 10 years, but every 10 months. So if they took the Apollo program and said, hey, what would it cost in today's dollars? And so it's adjusted for inflation. The Apollo program cost $300 billion over 10 years. AI companies are doing that every 10 months. That's a big deal. That's a lot of money. Again, we're looking at companies, not a U.S. government. The U.S. government was the one that did the Apollo program and put $300 billion of adjusted money into it. But this is private companies doing that. So this year alone, tech companies are projected to spend about $400 billion to train and operate AI models. All right, so that's the spending. But let's look at this. This comes from Yahoo Finance. So the big companies, so Microsoft, Meta, Tesla, Amazon, Google, have invested $560 billion over the past 2 years, but they've brought in $35 billion. Now, do the math on that. Imagine for a minute, what do you pay for AI? Okay. Now you may pay nothing, but if if you have a paid version of ChatGPT or a paid version of Copilot from Microsoft, or maybe you pay for Anthropic's Claude. What do you pay for that? So personally, I experiment a lot with different AIs and figure out how to use them well and do a lot of research because I do this teaching and training. So I pay $200 for Claude. I think I paid $20 for ChatGPT, and I pay also for Copilot. But imagine, let's just say the $20. What would I have to pay would I have a change in order to get to that $560 billion of revenue, just to break even? Well, that's about 20 times what we're currently making in revenue. So if I just multiplied everything they charge people by 20, that would get them to the $560 billion mark. What does that mean? It'd mean I'd be paying $400 a month for ChatGPT. I would be paying, $8,000 a month for Claude? These are not numbers that I could ever consider sustaining. And that's true for practically everybody. So I didn't pull it in here, but there was a discussion with inside of OpenAI about offering I think it was $2,000 a month plan for OpenAI, $2,000 a month. But notice, even at that number, it's not going to be enough to bring them up to $560 billion that they would need. And that is just the past 2 years. Coming up, they're spending even more. Now, along with this, I wanted to kind of point this out. The recent MIT study found that 95% of AI pilot projects fail, as in they yield no meaningful results. Now, that's with an investment of $40 billion. 95% had no meaningful results. That's a problem because you have a very expensive product and people were trying to figure out how to make this work. Trying to figure out, okay, we have the product, now what's the fit? Where do you put it? 95% of those projects fail. So even with the product, people are not finding a way to make it useful. Now, that's not to say it's not useful. It's very useful, and more people are using AI. But we're talking about trying to integrate it into different products and trying different ways to put AI into the pipeline, not just chat. Right? But 95% of those pilot projects have failed, and that was with an investment of $40 billion. So people are putting lots of money trying to figure out how to make it work, and it doesn't work. Well, that is with the current pricing structure. Imagine what has to happen to get to 20 times that pricing structure. It just doesn't seem to work. So this disconnect between investment and returns echoes the fundamental problems that ultimately doomed the dot-com bubble. So there's some kind of comparisons going on in this same technology space. Now, this is an article that came out a couple of days ago, I believe. October 7th. And this is from Bloomberg. If you don't have a Bloomberg subscription, I'm sorry, but I will link it down there. You can go ahead and subscribe or get a free trial. But this is kind of their look at the fact that there's circular money going on. There's lots of big numbers going on, but when you look at the headlines, you might see things like NVIDIA invested $100 billion in OpenAI. Okay, that sounds awesome. OpenAI's got $100 billion more of investment. But wait a minute, OpenAI is giving $100 billion or more to NVIDIA for their chips. So now NVIDIA is giving money to OpenAI. OpenAI is turning around and giving that same money back to NVIDIA. So they both can announce that they had $100 billion plus investments or $100 billion sales, but then that money is just circular. It's going back around. And that doesn't mean sustainability. That means that you're kind of hiding things. And in fact, NVIDIA is being kind of criticized because of the fact that they're kind of propping the market up because they're also one of the biggest winners in the AI race. Because everyone who needs to build an AI or wants to build an AI comes to NVIDIA for chips. So therefore, they're kind of propping the market up because they want to see this market grow because they are vastly benefiting off this market. Now, this happened again. OpenAI struck a similar deal with AMD to deploy tens of billions of dollars worth of its chips. And in part, OpenAI then gets to be one of AMD's largest shareholders. So then what happens? So OpenAI says, hey, we're going to use a lot of your chips. And then AMD gives them stock. And so now, because AMD has this big influx of purchases from OpenAI, their stock goes up, which means that money goes back to OpenAI, which kind of pays off those chip purchases. And it's kind of a circular thing again. And in fact, this chart over here shows where money is flowing in, out of these various companies. And it's all getting kind of passed around, which isn't always bad. There is the idea of this being okay and this being what happens, right? Like, some companies are going to buy from other companies who then are going to invest in those original companies and a rising tide lifts all boats, right? Well, yes and no. It can be that. And the bigger deal here is that OpenAI especially is looking to get AMD and Microsoft and Oracle and these other companies to be tied to the success of OpenAI, because then when they are, then they're going to make sure that they lift up or prop up OpenAI if there's ever a struggle. Because then they can more easily sustain their market leader position by saying, hey, if we fail, you fail. And so those other companies who have deep pockets are going to want to make sure that they don't fail. All right, moving on. By 2030, this is an estimate from Bain & Company. Companies will need $2 trillion in combined annual revenue to fund the computing power needed to meet projected demands. $2 trillion. While in that same report, the revenue is likely to be about $200 billion, meaning it falls $800 billion short. Effectively, they're going to have revenue that is equal to 10% of their needs. Not to make a profit, just to match the computing power costs. So they're going to need to either increase prices by 10 times or find a way to decrease costs. And unfortunately, it's not looking like decreasing costs is really a possibility because of the fact that whenever they create a new model, like ChatGPT came out with GPT-5, well, that new model is bigger and more powerful and takes longer to build, which means it's more expensive, not less. So at some point, you got to say either the models can't get any bigger and we then don't have a reason to create new models, or we have to multiply our price times 10. Neither is sustainable. Okay. And then remember that these models, it's not just the creation, which is very expensive, but it's also the running of the model. The models are very expensive to run, and we're not paying anywhere near, as you can see, we're not paying anywhere near what it costs to operate those models. Every time you make a query, you're talking about real dollars coming out of the pocket of OpenAI and others because they are saying, hey, we will operate at a loss. In OpenAI, they're projecting a loss until 2029. Now, according to outside researchers, they're saying it's not even going to be 2029. It's going to be longer than that, if ever. So there's a real problem here. And again, this is 2030. This is 5 years from now. Well, In 5 years from now, who's going to still have money to keep losing money? Because we're talking about losing money all the way up through here. That's going to weed out a lot of people. All right. This is, I think, the biggest danger to AI. And it's a question I get asked a lot, and the answer isn't always great. But Austin, Texas is using an on-premise AI system. So what they're doing is they're using a local AI. They're not using the OpenAI model or the Claude model or other models from these large companies. They're using an offline, a model that is local, which means they're paying only the compute cost for running that model themselves, and it's much, much smaller. Now, this is true. It's much, much smaller, but it's also a much more focused model. It does one thing rather than everything. The mega models try and do everything, whereas a local model can be more tightly focused on one thing. Well, that is sustainable for Austin in their, it's right now doing residential permits. So that could be sustainable. Whereas if you use the mega models, as it's talking about here, they attract headlines, they consume billions in capital, and they struggle to demonstrate sustainable economics. Imagine if Austin based their application on one of these mega models. Well, what happens when at some point the costs go up to try and match what it actually costs? Well, all of a sudden their system, which they built around an AI, isn't sustainable. And they crash, their application crashes, and they lose out on being able to do anything. Well, that's why they say, you know what, we're going to do a local model instead. And this is the danger, because if companies start realizing that they can get a local model to do what they're looking for, well, remember those 95% of projects that fail? Well, what would they have failed if they used local models? Maybe or maybe not. But if they didn't fail, they are now much cheaper to operate. And maybe part of the reason why they fail, and in fact, I know the reason why some of them failed, is because of the costs. And that's with the lower costs that are intentionally below what the actual cost is. So if you could run a cheap model that, sure, isn't OpenAI size, it isn't GPT-5 size, but it can do a job of what you're asking it to do, well, then you're probably going to do that, right? And avoid tying yourself to these models that are massive and are going to cost a lot. All of a sudden, more and more of the market for AI is going to be eaten up by cheap models rather than mega models. So now there's going to be another market leader, and that market leader is going to be small, cheap to operate models. And that's not somewhere that OpenAI and others can compete because their costs are just so high. So that is the danger on the other end. So the costs are the danger for the mega models. The other danger from the bottom end is the cheap models coming and eating away at the market from the bottom, especially when OpenAI and others are going to start charging what it costs. Because companies will say, wait a minute, is there another way? Okay, so that's from Fortune. All right, so that's kind of the look at what what's happening in the bubble, but let's talk what happens next. So what happens next is a lot of AI-focused companies are going to fail. Costs will be too high, and the return on investment will just not be there. This may also include larger companies, not just the small ones. And also the stock market could take a major hit. It all depends on if the major models can find an equilibrium or not. If OpenAI can't find a way to make models economically viable, they could damage all of their partners, including Microsoft, NVIDIA, AMD, and more. Imagine what happens when Microsoft stock and NVIDIA stock and AMD stock and maybe an Oracle stock all take a hit at the same time as OpenAI's does. Well, that'd be a major depression in the market, which would have ripple effects for everyone's retirement and a whole bunch of other things. Those ripple effects could last for years. Now, if they can sustain some level of value while maintaining a profit, the bubble could deflate more than pop. And there might be less overall impact. And that's what they're trying to get to. They're trying to find a way to get to the point of really making something sustainable. But I think the scariest thing for me is when you look at what is OpenAI really pushing for. They're pushing for AGI. Okay, they're pushing for the idea of general intelligence. They're hoping that with their continued research and the continued look at these models and making the models bigger, that it would go from being a bigger model to a model that starts thinking for itself, that can be much more generally intelligent. And if that were to happen, well, that'd be a huge revolutionary step in the AI process. The problem is that more and more it's become more and more obvious that that's not going to happen out of this process. The GPT-5 model was okay, right? But that's a big leap from GPT-4, right? Well, not really. So we're seeing the diminishing returns from this massive input, this massive workload to try to get these models to be more and more intelligent, to be more and more capable models. And really, when you talk to people who are knowledgeable at how AGI might work and they're doing their research into that, you'll find they're saying, you know what, just putting more and more inputs in doesn't create intelligence. We've seen this. And so the foundation on which this is built probably isn't going to result in AGI, which means that the end goal of OpenAI might not be ever hit, especially not that way. And especially not in 5 years. Well, if that's the case, then at some point they run out of money. And at some point, the bill comes due. So what does this mean for developers? I think there are 3 things that it means for developers. Number one, be careful when considering working for an AI company. Not a company that uses AI, but a company that is all about AI, right? That's built on a foundation of being for AI, based on AI, et cetera. Make sure their business model makes financial sense. If the company is tied directly to OpenAI and would not be sustainable without that tie, that's a problem. Same thing if you're tied to Anthropic or any of these other models. I'm using OpenAI as kind of the generic term because they are the market leader right now. All right, number 2, realize that AI isn't going anywhere. It may change, but it won't completely disappear. We saw that illustration of Austin, Texas, and how they're using an on-prem version of an AI. That won't go away just because even if the OpenAI went away entirely, doesn't matter. That AI is still there. We're gonna have others like it. So we're going to see that AI is still going to be here, right? Just like .com companies are still here. We still have Google and Amazon and eBay and more companies that have been established since then. But they're getting more realistic. They're getting more based upon actual value, okay? That means that you need to learn how to work effectively with AI, okay? Especially in the developer space, we look at AI as kind of this one big pot, but it really isn't. For developers, we have AI-powered tools. Now, those tools may change if the big mega models go away. They may not work for forever. They may have to change to local-only models. They may not be as good for forever. But what you need to do is learn how to use those tools effectively without getting into the hype, okay? Be very careful here because there's 2 ends of this pendulum. One is never AI, don't look at AI, don't talk to AI. That's a mistake. But on the other end is lean on AI so heavily that you don't actually do any real work. You just talk to the AI and make it do the work. That's also a mistake because now you're a replaceable developer. I talk about that in my Navigate AI course. There's 2 ends of the pendulum. Don't end on either one, all right? But this means that you need to learn how to effectively work with AI. Number 3, focus on building up your own skills apart from AI. Okay. Again, AI is not going to go anywhere, but if you want to have a sustained long-term career, you can't just be an AI jockey. Because if you are, well, then you don't know when the AI goes off the rails and all of a sudden you are a liability. We're already seeing this in a number of companies where they're creating AI work slop, where it looks good, it's mostly right, but there's some problems in it. And there's major companies that have had major problems because that work slop has been, turned in as the real thing. And the person or people who were managing the AI just let it do its thing. And as a result, they damage the company. And what happens when you damage a company? Usually you don't have a job for very long. And as well, what sets you apart? What sets you apart in the industry if you can just prompt an AI and so can the next person? You need to know how to check that work. You need to know how to ask the right questions. And that means having skills apart from just AI. Microsoft has kind of lost their way a bit with this. They have focused so heavily on AI tools and AI changes and Copilot that they've stopped talking about the other parts of development as much. And what's happened is that a lot of people have focused so heavily on AI that they've missed out on the rest of the stuff, how to actually build and deploy applications, how to actually build up a sustainable application. So you can set yourself apart by making sure that you're focusing on building up your own skills apart from just AI. Okay? Be a more valuable developer. Now, how do we avoid the worst of the bubble's effects? Because when the bubble breaks, whether it be a pop or a deflation, it's going to have some impacts. So here are 4 things to look for. Number 1, be careful about investing in AI companies specifically. So you'll see a lot of, probably too good to be true offerings where they're like, hey, we're a $100 billion company. We just need your investment of $1,000 and we're going to, turn that into $100,000 in 3 years. That's not really true. This is almost the Nigerian prince scam level of don't do this, okay? Be very careful. There's a lot of people out there that are very confident, that have all the right words to say, that are starting to grift on the AI trend. And they are building up companies that have no product, no income, no kind of hope for anything for a few years. And they're saying, hey, we're going to do this. And they're going to have great portfolios. They're going to have great, prospectuses of this is what you might do. Be careful investing in those companies. Number 2, if you have retirement, if you have a stock portfolio, be careful to make sure it's a diversified portfolio. Don't just lean on tech-heavy stocks. Now, that's kind of difficult because they're the ones that are making huge leaps, and that looks really great in your 401k. It looks really great in your investment portfolio when you look at that and go, man, I'm up 20% this year. I'm up 17% this year. That's great. And I'm looking at mine going, this is awesome. But be careful that you don't have so much in those tech stocks that if they were to take a major hit, that you would take a major hit. Now, that's hard because, if you invested in Microsoft 20 years ago, you'd be very, very rich. And some companies are going to come through just fine and they'll become market leaders. And so there's going to be some successes if you can last long enough. If you invest in Google, Amazon lost money for so long. I laughed at it every quarter when they came out with a new report because they just kept losing money. And I was like, when is this going to end? And well, we see where Amazon is now. But that is the vast minority of the .com companies that came through the .com bubble. Most of them went away. Be careful. All right. Number 3, be prepared to get a new job. This is hard. It's hard to think about, there might be major market upheaval, which would include major layoffs, but this might happen. So be prepared to get a new job. I talk to people who are very comfortable in jobs. I've worked with people who are very comfortable in their jobs. And it's really hard to say, yeah, I'm going to be prepared because they're comfortable. They have, the great vacation. They have the great, work day. It's a short work day. It's only 8 to 5 or 9 to 5. And, when they leave at 5, they never check their laptop, and they're focused on all the other things like vacations and, going to a lake, etc. Be careful, because that is a trap if you're not careful. Ask yourself, what would I do if this job went away tomorrow? Would I be able to hit the ground running, or would I be playing catch up? Because if a large section of people gets laid off, you are now in the midst of a large pool of people. If you are not near the front, you're going to have a harder time. So set yourself up now for success. Make sure you have an up-to-date resume. Make sure you have a portfolio of work to show off for things you might not have done in your current job, but you know how to do. Make sure you have up-to-date skills. Be prepared to stand out from the crowd. Too many people think that if they look like everybody else, they'll somehow be picked for a new job. That's not how it works. That's relying on luck and hope. And those aren't good things to rely on. This is not Vegas. You don't want to be gambling. What you want to do is you want to set yourself up for long-term success by being prepared before something happens. Don't try and prepare yourself when it's kind of too late, when you're already out of a job. So that's number 3. Number 4, avoid tying your company's technology to remote models without a good backup plan. So if your company has an app and you say, you know what, the great place to put an AI, this would be really helpful. Well, that may be true, but be careful of tying it to just OpenAI or another remote model without having a plan of what happens if we can't afford that next month or next year. What if they come to us and say, yeah, the price goes up by 10% or 50% or 1,000%? What do we do? What happens when that price goes up too far for our budget? Is there a way to back out of this? Is there a plan B? Or do we now have an application, a company relying on an application that can no longer work, that we can't afford to run? Because if you're not careful, you can set your own company up for failure. Don't do that. There are ways to use AI, and I'm sure that there's a lot of companies out there saying, hey, how can we cram AI into this bad spot? Be careful of that. There's a way to push back on that. But even if you're doing it for a good thing, be careful to set yourself up and your company up for long-term success. AI is in a major bubble right now. The economics won't sustain the industry spending forever. But that also doesn't mean the bubble is going to pop right away. Spending will continue until the funding gets depleted and loans can't be secured. Since massive companies like Microsoft, Google, Meta, Nvidia, and more are investing in AI, that could be a few years, or it could be a few months. While we can't control what happens next, what we can do is prepare for the future as best we can. That includes making wise decisions when building applications, when keeping our skills up to date, and by avoiding investing in things that look too good to be true. Thanks for watching, and as always, I am Tim Corey.